Hello, and welcome to Rocket Fuel, your daily update of everything that's happening in the Rocket Pool community. My name is Wack. Today is October 4th, and today's episode is going to cover the first ETH-only validators on the Haleshki testnet. Langers talks a little bit about roadmap, and Val's got some interesting explainers about the three Saturns. And on the Ethereum side, we are going to be talking about Larry Fink, Visa, and an explainer on megaETH that you might have heard about. So let's get started.
10, 9, ignition sequence start, 6.
So we're going to be starting here with this screenshot from the Etherscan page for Haleshki, and this is a transaction showing that there has been a new validator started on testnet, and this is an ETH only validator with no RPL. And you can have a look over here. So it's deposited with a credit, and it was one Gwei gas, and there's information here as well about how it worked and everything. But that's it now. A couple of other people have done this as well. So on testnet, you can actually start playing around with setting up ETH only validators, and it looks like, this was one of the barriers towards potentially getting ready for October 24th. And now, we'll have 3 weeks basically for this testnet to run until it goes live on mainnet. So it should be that everything goes smoothly. It should be that there's no bugs or any problems like that. Like I said, it's just parameter changes on the smart contracts. There's no contract changes, which of course is very exciting. But this is it now. This is the home stretch, and we are just 3 weeks away from getting a mainnet. Of course, the votes still have to pass, and they've still got over a week to go, but we are getting closer every day to that happening, and those votes passing like fairly convincingly. But yeah, this is really great, and Rocket Pool is about to start a new era. Okay, next up is we have this update from Langers, and Langers says, "Hey everyone, as per RPIP 37 protocol development, the core protocol team has facilitated a prioritization discussion with the Rocket Pool community. This summary follows my protocol development roadmap prioritization," and then it links to the forum where there was a post made about this. This is posted on the DAO forum. And Langers goes on to say, "The discussion received limited feedback, but it was enlightening all the same. A strong signal was sent that we should focus on Saturn, which is not unsurprising, which supports Rocket Pool's competitive position in the staking market." And then Langers goes on to say, "It was also raised by Noshua that we had previously committed to reducing the PDAO Guardian and ODAO Trust. Houston enables complete removal of the PDAO Guardian. In terms of ODAO Trust, delivering Saturn is the top priority, so some of those initiatives will have to be pushed back to ensure efficient delivery. That said, both Houston and Saturn introduced some key technical components that lay the groundwork for further innovation in that space. Saturn will also remove the scrub check process as an ODAO responsibility." And then here there's more details, and Aramana and Scuzzle have highlighted the need for better coordination and use of resources to drive Rocket Pool forward. And as a team, we completely agree and hope to work with the community on that in the near term. As we dive deeper into Saturn work, the team is genuinely excited for this new chapter in Rocket Pool's evolution. We look forward to the opportunities that lie ahead. So this, of course, is incredibly exciting, and the roadmap stuff I think was quite straightforward this year, where it was just work on Saturn and get Saturn done, and that's what Langers kind of made that clear as well. But that's really awesome that that we're getting that officially now, and of course the team's pay goes from year to year, and they'll be due their new payment soon as well. But this is really cool. So thank you, Langers, for that. Okay, next we have this post from Val. And my links got messed up a little bit, so I'm sorry about that. Just give me a second. Let me refresh the page. We have this post from Val. So Val has been known in the Rocket Pool Discord to make these support template answers once in a while, and he actually really did a wonderful job with this one. So I guess people have been asking questions about, what is Saturn 0, what's Saturn 1, what's Saturn 2, what's going to be included in each of them. And these are questions from, long-standing community members who've been around for a while, and they've still been asking these kind of questions about, what is going to go into the different Saturns, how is it going to break down. Well, Val put together this sheet, this answer support template that you can call by doing /support template use, and then search for the Saturn TLDRs. So Saturn 0 says this is a stepping stone on the way to Saturn 1, which allows Rocket Pool to get TVL from folks that don't wish to stake RPL earlier, allow new mini pools to be created without staked RPL. Commission for those mini pools will be set at 5% in contract. They'll get bonus per commission from 5%, no RPL staked, up to 9% RPL stake and more than 10% borrowed ETH. And then the bonus commission will go away after 4 rewards periods after Saturn 1 to strongly encourage folks to migrate. I'm not sure if that's 5 or 4, so it might be 5 because I'm sure I saw 5 somewhere else recently, but maybe it's 4. And then the TBD, the minimum stake to qualify for RPL rewards should be 10% borrowed as it is, or 0% depending on the vote outcome. And the vote is currently live, and it's due late October, so October 24th date that we want. And it looks like at the moment the removal of the cliff for RPL rewards will be going away. Then with Saturn 1, we've got some new parameters. So we'll get universal parameters, node operator share, voter share, and RETH commission. And this can be set at the protocol level, which will allow us to listen to and respond to the market. We'll have a lower bond requirement, LEB4s per validator, so yay capital efficiency. RPL value capture, so as part of the ETH revenue goes towards eligible staked RPL per voter share. With mega pools, many validators can be associated with a single contract, which massively helps costs. Forced delegate upgrade 4 months after the mega pool delegate is upgraded by their node operators. Any mega pools that have not upgraded can be upgraded permissionlessly. This prevents having to support a growing number of contracts over time. Express queue, node operators can use tickets to get their validators matched to the protocol ETH faster. Nodes get 2 tickets plus 1 ticket per 4 ETH bonded when Saturn 1 goes live. And upgrade guardrails, so it makes 2 parties of the PDAO or DAO Security Council must agree in order to upgrade contracts. And then finally with Saturn 2, so we have lower bond again, and this is 4 ETH for the first 2 validators, then 1.5 ETH per validator after that, so even more capital efficiency. And then Val explains that the RPL value capture, there'll be a vote on how to capture, could be continue to go to the voter share or use buyback and burn mechanism or a buy and LP mechanism. And then we'll have forced exits in case of penalties and remove RPL rewards for node operators and the inflation for it. So the yearly inflation will go from 5% to 3%. I thought it was actually going to go down a bit more than that, down to 1.5%. But I guess some of these things are still being figured out. And it looks like I need to get caught up to date with some of this information. So, yeah. And Valdov says this exists at Chaos is urging. So we were all quite happy about that. And then people said, thank you, Val. Thank you. And these are people who've been around, for quite a long time, like Lee and Schifrin, saying thank you because they found it really valuable. And then Sneaky Ninja Guy asked for a explain like M5 version. So Val actually put that together. So mini pools can be created with RPL, stepping stone to capture TVL in preparation for Saturn 1, and that is Saturn 0. More capital efficient for ETH, more gas efficient with many validators. Share of ETH revenue goes to vote eligible RPL and protocol wide settings so we can react to the market, and that's Saturn 1. And then Saturn 2 is even more capital efficient. A share of ETH rewards revenues goes to RPL with details to be determined, and remove RPL rewards and reduce inflation to 1.5% down from 5%. So yeah, it seems like Val made a mistake in the earlier one, and it is actually 1.5% like I had originally thought. But this is really, really great information. So I'm going to be pointing people to these answers quite a lot when they have questions about Saturn and just want some high level information. What I've been doing until now is just pointing them towards explainer documents, which while they are incredibly detailed, very well written and easily understandable, it's quite a lot of information for you to get through. But this is a really great starting point for people now who want information about what the 3 Saturns are. And I really like the community's kind of like coalesced around this branding of Saturn 0, Saturn 1, and Saturn 2. It's really cool. Okay, and next we already did that. Okay, so let's move on to some Ethereum news now, and there's some really exciting stuff happening. So here, Larry Fink was on Fox Business, and he was being asked a whole bunch of questions, And one of the things that he said is the underlying technology of crypto is really useful because we don't need custodians anymore. So here what Larry Fink is saying is that, one of the great jobs of crypto, and he means Ethereum because BlackRock are building on Ethereum, is that, you can build things without intermediaries, without custodians, and things can happen on chain in a way that is way, 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 way more efficient than using TradFi rails. So JC here says Larry Fink is now openly implying that custodians of financial assets will be replaced by Ethereum, but he's not going far enough. All the financial intermediaries will be replaced. The banking business is about maintaining the ledger for everyone. Ethereum is literally a distributed ledger, so it competes against them. Banking laws are about to get are about regulating the custody of power banks, but custodians will be removed, so those laws will become useless. Custodians in the equity markets are directly threatened by crypto and self-custody that are probably the most scared entities of Ethereum in TradFi. But exchanges, clearinghouses, central banks, all are afraid of Ethereum. Massive shift coming in the financial world. Ethereum is the new financial system. So here JC took information that, Larry Fink is saying and kind of extrapolated out from the fact that, BlackRock are building on Ethereum with a Biddle fund and interested potentially in doing their own layer 2 and a whole lot of other things. But when you start to think of it in this way, you can see that there's big, big things coming. And that's really awesome to see. And then Adriano jokes and says, nah, bro, he's talking about Solana. That's why they issued their stablecoin on it. And JC just laughs. So yeah, this is the beginning of Larry Fink starting to talk about Ethereum, because I think it happened, 8 months ago, maybe a little bit longer than that, maybe a year ago, where Larry Fink started to talk about Bitcoin and crypto. And of course, at that time, there wasn't a product for them to sell, but they were getting ready for the BTC ETF. And then once they got the BTC ETF, of course, the ETH one came a few months later. But Larry's never really shilled the ETH ETF or Ethereum as a whole. And I think this is just the beginning of that story now, where he is talking about crypto potentially like replacing the financial system, which of course we have known for a while. Like we believed that for a while, and hopefully in the next few years we're going to start seeing that happening. However, it might be that we don't have to wait a few years and we're going to start seeing things a whole lot sooner. I talked about this in Rocket Fuel a couple of months ago, but now we've had a lot of progress. So here, Kai Sheffield, who is the head of crypto at Visa, shared information saying, excited to introduce the Visa tokenized asset platform, a new Visa product to help bring banks on chain, and our partnership with the BBVA Bank from Spain to power their first stablecoin. So this is, the head of Visa. Visa is one of the biggest payments companies in the world. Here saying that they are going to be bringing banks on chain and using the on chain word without a space as well. Like it's just cleaner that way. So these guys know their crypto, right? And they've been like dabbling in the space for many years now, and they're taking their steps. They're taking big steps now, past just regular testing. And we can see that because when you have a look at the news details of this release, it says Visa introduces the Visa tokenized asset platform. And it says the Visa tokenized asset platform is a new product that helps bank issue fiat-backed tokens. BBVA will use the VTAP to create tokens on the public Ethereum blockchain with expected live pilots in 2025. So here you can see that they already are talking about building on Ethereum, and they are talking about using the public Ethereum, not a private EVM or a fork of Ethereum, but this is literally like the Ethereum that you and I use every day. And this is absolutely amazing that it's happened like that, and they're moving fast. So 2025 could be a huge year for crypto adoption, and we'll start seeing more and more of these like huge players get involved with it. Let's have a look at some of the takes about this. So Nate here says Visa introduces tokenized asset platform designed to help financial institutions and issues and manage fiat-backed tokens on blockchain networks. Initial pilot live using Ethereum could help power the future exchange of new types of real-world assets. Paying attention yet? Question mark. And of course, this is happening on Ethereum, which is one of the key pieces of information here. And then real world assets.xyz, rwa.xyz saying Visa's launching their tokenized assets on Ethereum. Largest payments company in the world just announced their tokenization platform. And this is with the second biggest bank in Spain, who have over $750 billion in assets. And they want to use their stablecoin. The institutions are here. And then Eric says no one is really competing with Ethereum when it comes to things like Visa launching tokenized assets. There's simply no other platform these companies are going to choose. Ethereum will be the world's global financial settlement layer, and ETH will be its money. So I think what Eric here is kind of imagining is a world where these banks will have their own stable coins, and there'll be a Visa L2 that settles down to Ethereum. And, this will be in a peer DAS / many blobs world. And they will have cheap, plentiful, abundant data, and sub-second settlement of fees. And this is the world that Visa are kind of envisaging. And then what you will probably, hopefully, eventually see is all of Visa's business just moving on chain, because it's just going to be so much more efficient for Visa to run their credit cards and all their credit systems on chain compared to doing it the way they do now with all these centralized databases and huge infrastructure needs that come with that. Eventually it'll just all be on Ethereum, and that it might be a few years away, but the groundwork for that is being laid right now. And you have to remember that the advantages that Visa will get from doing this are astronomical. So for example, if you travel abroad and if you make a payment, it can take days or weeks for that to settle, and in that meantime, Visa has issues with any chargebacks that might happen, or there might be issues, getting the currencies across border for, the merchants elsewhere, and that whole process can take such a long time. However, once you move it to blockchain, a whole lot of the barriers to speeding things up will be removed right away. And finally, we've got a take here from DC Investor, and this was one of those tweets that really sums up, why I'm so bullish about Ethereum and crypto right now. Ethereum especially, even though, the times might be that people are kind of bearish and scared of what's happening. And, the price action, of course, impacts that a lot. But DC Investor says, what do the following all have in common? BlackRock, the world's largest asset manager. Coinbase, largest crypto exchange in the US. Sony, one of the world's largest electronics and entertainment companies. Visa, the world's largest payment processor, and he says they're all building on Ethereum. And then Hani Abu replies by saying, don't forget Swift, the global financial messaging infrastructure. And then other people started talking about, can you let the price know? The fact is, right, the price might know or might not know, and that's besides the point. But I think this is one of those things that really hits it home for me when I hear bearish takes about Ethereum, or if I hear that other blockchains are doing this better, that I see sometimes when I'm trying to get countering or opposing views, and when I stop and think about it for a second, I realize that they're really wrong, right? And the proof is right here in what's happening and who's building here. And a lot of these, are early forays into building on Ethereum, and it's possible that, that changes next year or the year after that or the year after that. But right now, this is all making me extremely bullish for what we're seeing happening on the blockchain and what we're seeing that's going to happen with crypto and Ethereum specifically. So I am here for it. I'm excited about it, and I'm really looking forward to even more companies and corporations and nation states building on top of Ethereum. Okay, talking about building on top of Ethereum, here we have a new proposal for a new ETF, and this is from Franklin Templeton, and they're submitting a proposal for a Bitcoin and Ethereum ETF index to the SEC. And this will be the first to combine the BTC and ETH in a single fund, but this is pending approval. So there's still some details that we're waiting to find out from here, such as how will the assets be divided? It's most likely will be market cap weighted. And of course, we need the SEC to approve this. But since we have those spot ETFs already, approval of this should be quite straightforward, really. I don't expect it to take too long. In a sense, these ETFs will actually be really helpful for ETH, the asset. And that is because the ETF for ETH has been lackluster so far, and it hasn't quite had the impact that the BTC ones have. There's one of the reasons I think that's happened is because people got, the BTC one started in January, so people were in the position where they wanted to allocate to crypto at that time. and they were able to do that, because it was the only one there. When ETH came along, I think some of the people didn't want to move their positions around. I don't know how accurate that is or isn't, but it kind of makes sense. And then we'll need something to kind of draw those people in. And one of the things that helps a lot is price action. So if ETH starts to outperform Bitcoin in the next few months, we might see more and more people jumping on the ETH bandwagon. But also something like this kind of ETF where it's market cap weighted. We know that $1 into Bitcoin, according to its market cap, the same weight going into ETH will actually have an outsized impact on its price because it's a smaller market. It takes less to move it up more. So hopefully, these index ETFs can really potentially set us on the path of really good ratio gains to highs that we've not seen in a long time. Okay, next there's this thread here from Satyaki, and this is about megaETH. So megaETH is an L2 that you might have heard of, but might not know about. And this is they're saying Vitalik Sriram backed Ethereum scaling solution. Wait, another L2? Yes, but it's special. Let me tell you how. So I'm just going to take a couple of minutes to tell you about megaETH. I'm not invested in megaETH. They're not paid me any money or anything like that. So here, Satyaki says, according to L2B, currently there's over 100 L2s with a new solution coming up online pretty much every day. But the problem is none of them are Web 2 level efficient. And here we see how much gas they use. So Op BNB uses 100 megagas per second, and then we also have Binance Smart Chain using 46 megagas per second, and then they have target gas per block and block times as well. So here they're saying modern Web 2 servers have over a million TPS, and they have a lot more megagas. So it's a completely different level. So here Satya says, even with L2's blockchains of poor computation efficiency, to find the nth Fibonacci number, Op BNB, the most efficient L2, takes 55 seconds, whereas similar code in C takes 30 milliseconds, 1,833 times faster with a single core GPU. It says another issue is the block time. Arbitrum has the shortest block time at a quarter of a second, but to enable real-time dApps, you need block times that have between 10 to 100 milliseconds. So now you know why we need another L2. So they're just setting their problem, saying that the L2s we have right now are not performant enough. Even alternate L1s are not performant enough. So this is how to learn about... before you learn how megaETH solves this, let's see how L2s tackle the initial scalability bottleneck. So it says in Ethereum that they did it like this, and then L2s did it like this, and then megaETH, it says, takes node specialization one step further. The protocol implements 4 unique node types in its design. This offers real-time performance with 100,000 transactions per second with a 1 millisecond latency. So they're saying that the following node types megaETH employs are sequencer, prover, replica node, and full node. And then there's some details here about how they all work and what kind of hardware requirements you need. So for example, to be a sequencer, you need a 100 core CPU and then 1 to 4 terabytes of memory, which is an obscene amount of power. To be a prover, you need one core CPU, but you need half a gigabyte of memory and 10 gigabits per second network speed. And that's the same for all of them pretty much. With the replica node, you need 4 to 8 core CPU, 8 gigabyte memory, and 100 megabits per second network speed. And for a full node, you need 16 core CPU, 64 gigabyte memory, 2 to 300 megabits per second network, and they're saying high end, but still much cheaper than sequencers since the job is only re-execute transactions. So then they have got a workflow for what it looks like, and sequence executes transactions and submits the eigenDA. So that's one of the key differences, that they're not going to be using blobs as their data availability layer. They'll be using eigenlayers, eigenDA, which is one of the products coming out of the eigenlayer ecosystem. And then they said that with the quadruple node design, it looks super promising for megaETH, and if implemented as envisioned, we'll see will have a real-time Ethereum, a true hyperscale blockchain backed by the strongest security layer. So together, let's make Ethereum great again. And that's where the megaETH comes from. So make Ethereum great again, ETH. So this is really interesting. And I think that this is going to be one of those L2s that is going to be hyper performant. And there's others in the works as well. But megaETH is one of those that I think a lot of people will be using come next year, I think is when it goes live. Okay, let's talk about this eigenlayer for a second, since we're just talking about EigenDA. And hold on one second. Actually, no, we're going to skip that story, so that's okay. We are actually going to be talking about staking, and this story here from Anthony Sassano got a lot of traction and a whole lot of responses, and kind of brought up some drama as well. So let's have a look and see what it's about. So here, Sasal says, the main reason I was initially so interested in Ethereum all those years ago was because of Ethereum's planned move to proof of stake mechanism, where people could stake from home. Fast forward a few years, I was setting up my own solo validator to be ready for December 1st, 2020 Genesis event on the Beacon chain. Now, a few years later, I run my solo validators from home on my own hardware, and they're managed completely by me. And I've also learned a lot of things along the way about various different topics. Solo staking is the very beating heart of Ethereum. It's something we should defend as strongly as we defend the importance of ETH being valuable. Without solo staking and the ability to run full nodes at home, we lose the only thing that is worth anything real in this entire ecosystem: true decentralization. So this actually, was part of this discussion that's been going on for the last couple of weeks now about staking and this value proposition, and how it might be home staking might be a bottleneck for Ethereum, or how planning Ethereum's changes with that in mind can be a bottleneck, basically. So what do we have here? Again, this has kind of brought up a lot of drama, but a lot of interest too. So here, question is not solo staking or not, it's what is the minimum requirements should they have. And then Vitalik responded as well, and he says, I think it's the same version of this when we recognize that 32 ETH is much more of a barrier than bandwidth requirements, and temporarily do a trade where we up the bandwidth requirements a bit, and in exchange drop the staking deposited minimum to either 16 or 24 ETH. It's net good for both staking accessibility and scale. And once we figure out PDAS, bandwidth requirements go back down. And once we figure out orbit single slot finality, the deposit minimum can drop to 1 ETH. And then Phonax says, Phonax, of course, is Rocket Pool team member. He says, I don't think there's a lot of people waiting for the 32 ETH requirement to lower to start running a validator. They could run one on much lower entry already. And of course, this is with Lido, CSM, and Puffer. They're already, Puffer has a product live where you can stake with 2 ETH. Lido's letting you go down with like 1.5 ETH or 2.5 ETH, depending on permissioned or permissionless. With Rocket Pool, we are going to allow the 8 ETH validators, of course, which are starting in 3 weeks' time. But also with Saturn 1, we go down to 4 ETH. And with Saturn 2, we go down to 1.5 ETH. So the ETH, actually, that's 4 plus 4 plus 1.5 in perpetuity. So the barriers to entry are getting a lot lower from the hardware side. Here, Nixo actually had a really good point, saying, I don't think dropping the barrier even by half gains as much stakers as we lose by upping the bandwidth requirements without fully understanding the nature of the current problem. We've seen that many struggles might be more complex than just raw upload speeds. So POTUS here as well says, I don't agree with this take. We have solutions, while not optimal for DVTs and even Rocket Pool mini pools, but we have no solutions to the barrier that high bandwidth constraints pose on most of the world. And then POTUS says we should focus instead on separation of duties so that most decentralized layer is not necessarily exposed to the duties that requires high bandwidth. So there's some really interesting takes there. And then Max Resnick, of course, has been kind of the opposite side of this. So he actually put out a long reply here. Says, this post represents a very strange way of thinking to me. The way I was trained to think about problems is to start from desiderata. What do we want? What is the function we are trying to maximize? So he says, in this case for Ethereum, my proposed objective function would be that we want to build the highest throughput lowest latency chain, subject to the constraints that is safe, live, censorship resistant, has low MEV rents, and can be verified by users without the need for a trusted third party. In my view, a long tail of solo stakers is sufficient to satisfy some of these constraints, but not necessary. Moreover, if we do it wrong, we may actively harm the goal of making a high throughput, low latency chain with low MEV rents. He says, I do not believe that solo stakers are the heart of Ethereum. How could they be when Ethereum launched with proof of work, meaning it was nearly impossible to propose a block without significant hardware spend? So actually, other people said that, like DC Investor, he says users need to be able to verify the chain and operate the chain, and users must be able to fork the chain. These principles were true in proof of work, and they remain true in proof of stake. While it will be very inconvenient to today, it will result in great loss of financial value. It's still a possibility that could be deterrent to developer and institutional overreach. And then he says further, a small percentage of home users can ensure permissionless access to the chain, even if institutional power all choose to censor. I'm all for using data to help determine what we hardware and bandwidth spec, probably too low right now. He said we should optimize for, but starting from a point of maximizing throughput over reasonably maximizing home participation would be a critical error. These are factors which make Ethereum unique in a market filled with every other chain making the same trade-offs for throughput. Kill them and you just have a data center only chain which is slower, just as centralized as all of the competition. So that was actually a really interesting take by DC Investor. Jasper here had a reply as well saying, bro, and then kind of quoting Max saying, I don't believe that solo stakers are the heart of Ethereum. How could they be when Ethereum launched a proof of stake? So Jasper said, you didn't spend much time on ETH proof of work, did you? Many people who are now solo stakers actually did mine at home and were able to produce blocks without stupidly high costs for some number of years. And Jasper says it wasn't like Bitcoin where the ASICs ruled. Home mining was important then as home staking is now. And he has some information here saying, for the context, most home miners were part of mining pools, just as most home stakers are gradually joining staking pools. And he says it was a question of profitability. It's a question of probability, though, not cost, to determine whether a solo miner on a shitty GPU could propose. It was never impossible. And then he had some more data here. Oh, wait, let me see if I can find that data. Basically, Invis in the Rocket Pool Discord shared some information saying that the total terahashes right at the time of the merge, when it was at all-time highs, basically was around 2 million of some unit, and 1 unit of that was equal to a 3080 graphics card. So basically, if you had one 3080 graphics card, you were about 1/2 millionth of the network, and with there being 2 million blocks a year, then you basically had a 1 in 2 million chance of getting a block, which would happen approximately once a year. So there was the chance of getting good a block right by home staking with just one graphics card. And Jasper says many locations don't offer better internet. It's not a matter of price. The global median upload speed is only higher than 50 megabits per second in a tiny number of countries. So this was, like I said, a very, very active discussion. And then here we had another reply. This was from Punk 5736 saying, it's worth noting that many of these areas independent residential validators are also similarly miners in the proof of work area, including myself. The ability for a chain to be run by non-corporate, non-data center validators is a part of its resilience and neutrality strategy. The desiderata you are suggesting homogenizes and weakens Ethereum's consensus by corporatizing it and concentrating its computers in regulated, politicized environments. Validators in that context have limited autonomy and mobility, especially if the protocol does not enable their migration to residential segments of the internet. It's worth mentioning that validators in data centers don't have any physical control over their computers and weak custody over their keys. My perspective is that Ethereum does need to make updates to the minimum validator requirements and improve measurement in the bandwidth dimension as the protocol parameters become more contested. But that needs to happen in a way that strengthens commitment to the core of residential independent validators, not through a dismissive and narrow focus on performance. So I think that's kind of my perspective as well. That Punk 5736 shared so nicely in the last paragraph there. But this is a discussion that's going on, and it's quite like spicy at times, and it's still going. So I'll keep bringing updates for you about that. And then final word on this, I'm going to give to Eric Connor, saying one thing Ethereum needs to decide is where we land on the welcoming spectrum between solo stakers and users. So this is unlimited stakeability means more stakers but less blobs and block space users. Unlimited scalability means more blobs, block space users, but less stakers. Where is the happy medium? And he says, I think as a community, we'll all agree solo staking matters, but there is a point where we're too far on the solo staking side. So he says, staking on a potato using a G4 connection, a 4G connection, and being unwelcoming to more users. And then Ryan agrees with that, saying, I totally agree on being more welcoming, yet we can't abandon our scientific approach to the roadmap. We need more bandwidth studies. Where can't validators run today, and how does this get worse or better with roadmap changes? So there was a whole lot of information in this discussion, so I will leave that to you all to talk about more. But in some other news, we get this trailer for a documentary that's going to be coming out this week on HBO, and this is a HBO documentary that claims they have uncovered the true identity of Satoshi Nakamoto, the pseudonymous creator of Bitcoin. So this documentary claims to have uncovered the identity of Satoshi Nakamoto. So this, I think, is airing on Tuesday or Wednesday next week. I think on the 7th or 8th, basically. But you can watch it and find out what they think, or who they think is Satoshi. I think it's Hal Finney, but that's just what I've thought for a couple of years, based on some of the speculation or circumstantial evidence that people have shared in the past. But it's amazing that 15, 16 years later, we still don't know who Satoshi is, and he's on track to being one of the richest people in the world, or they are, or whoever they is. There's an outside chance that it is actually a member of the CIA. So here you actually can bet on this on Polymarket now, as you can with everything. So there's 3 options that seem to be getting the most traction. So it says, who will HBO documentary identify as Satoshi? So there's Len Sassaman. I'll be honest, I don't know much about Len, but I know that he was like early cryptographer, early user, but I don't know many details about him. Hal Finney at 18%, that's who I think. And then Nick Szabo, who I've known about Nick as well. He seems like there's a decent case. Hani Abu says no votes to the CIA. And then they're saying that this might be under the multiple parts, so there's 37% for that as well. So this at the moment is quite an illiquid market. There's not much money on there, so the prices will move quite fast. So be aware of that if you want to bet on this. But it's definitely a fascinating topic, and I think I'm going to try to give that documentary a watch when it's airing, because I think there might be a little bit of hubbub around it, and people will be really curious to know who this person who walked away from now what is worth billions of dollars, tens of billions of dollars. So yeah, it's a really exciting story. Okay, and we're going to finish today's episode with some talk about the unemployment numbers that came out today, and this of course is part of the macro picture and its impact on the crypto markets. So here we got this tweet saying the US economy adds 254,000 jobs in September, and this is way above the expectation of 147,000 jobs. The unemployment rate was 4.1%, which is below the expectations of 4.2%. So this number has actually gone down. So job numbers have beat expectations for the first time since May 2024. Was the Fed's 50 basis point cut too aggressive? So this is good if you believe in there being a soft landing for the US. You can bring your interest rates back down. The inflation is already down, and if you can keep the jobless rate numbers down, then that would be a soft landing. However, if something breaks, that's when you get a hard landing, and if many things break, that's how you get a crash. However, now the question is already coming up, was this 50% basis point too aggressive? And if we have a look at the FedWatch tool, we can see that in the last week, I think the week before, it looked like it was going to be a 0.5% cut, and now it's almost 97% certain that, this is what people are predicting, that will be a 0.5% cut. So we'll be getting 0.5% cut again in November. Of course, this is just a chance. This number is changing quite a lot, but that's what it's looking like. We will get. No, actually, this the current rate. I'm sorry, that I was reading it wrong. The current rate is 0.75 to 5%. Sorry, 4.75 to 5%, and it looks like it's going to go down by a quarter, not by a half. So that's kind of changed there, because it was looking like it was going to be a half, and there's even a 2% chance now that it will stay still and not move at all, which is fascinating to see. And then if you look at the December, then they're saying it's going to go down by another quarter of a point instead of another half of a point, which is what we were thinking today. What we were thinking just a couple of weeks ago, that it might go down by a lot more. But that jobs data, I think, was the last piece of information that we're going to get before the next rates cut. So it looks like, some of the messaging from the Fed saying, hey, we're going to take a slow and measured approach to this. We want to keep our eyes on blah, 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 and all this kind of stuff. It looks like that those numbers are going to go down slower than we had previously anticipated. So there is a 17% chance that we will still get a 0.5 percentage point cut in December, but that number was a lot higher before. So if we then go and have a look at the ETH price on Binance, you can see that over the course of today, once those numbers came out, prices have kind of rebounded a little bit from the lows from a couple of days ago. But I'm not saying the prices are up that much. It's up by 3%, but across the market, BTC is up a little bit, like 2% and a bit. ETH, of course, is up 3%. RPL is back above $10, so it's $10.06, which is up by 5%, and other tokens are up by similar margins as well. So it looks like it might be a slower road, but potentially a more sustainable and a healthier road in the long run. Of course, we don't want the economy to crash. We want everything to go through nicely and everything be nice and predictable for 2025. The more curveballs we have, with the recession or other things, the worse it'll be. But anyway, thank you all for watching, listening, and being part of the Rocket Fuel community. I hope you all have a lovely weekend ahead, and I will see you on Monday. Bye.